Hi everybody and welcome to Axion Token Channel. So in this video we're going to look at a DeFi and so you're going to learn all about that. It's really designed for beginners based on a Telegraph article, and I think I'm going to give you some good insights to it as we go. That's to pull out the really good things. If you're new to DeFi, decentralized finance on the blockchain, then this is for you. So I hope you enjoy this one. Let's get straight into it. So DeFi, a comprehensive guide to decentralized finance. And basically, after Bitcoin's launch in 2009, a robust industry blossomed, stemming from the asset, its concept, and its underlying technology. So that's how long it's been around. The crypto and blockchain space boasts different niches, and in which projects and companies can develop solutions for various use cases. One such niche, of course, is the decentralized finance DeFi sector, and this is really the big one at the moment. This is really big. I mean, there are other ones like NFTs, non-fungible tokens, but this is really where a lot of the money is, folks, because really it's what banks and investment companies do in traditional markets, and it's being basically disintermediated, basically replaced by DeFi on the blockchain. So pretty cool stuff there. Let's quickly get into it. One such niche is the decentralized finance sector, which was created as an alternative to traditional financial services. More specifically, DeFi is comprised of smart contracts, which in turn empower decentralized applications, or what we call DApps, and protocols. Many of the initial DeFi applications were built on Ethereum, and the majority of the ecosystem's total value locked remains concentrated there. So it's really the total amount of dollars or crypto equivalent that's in there. At its core, Bitcoin carries qualities touted as pillars of decentralization. DeFi, however, expands on those qualities, adding additional capabilities, and it does add a lot of innovations in the finance space around that. So what is DeFi? A subcategory within the broader crypto space, DeFi offers many of the services of the mainstream financial world in a fashion controlled by the masses instead of the central entity or entities. That's a super big thing. So you don't have some big bank over leading you, taking deposits, lending out, controlling the whole thing, taking their profit cut all the time. This is really a game changer where the power is put back into the hands of the people on decentralized platforms. Some more innovative ones like Wise B have allowed 100% of the profits to go back to investors. So it's pretty huge stuff happening here, real game changer. Lending may have started it all, but DeFi applications now have a number of use cases giving participants access to savings, investments, trading, market making, and more. So there's all these different types of products and use cases sitting under decentralization. Decentralization's finance ultimate goal is to challenge and eventually replace traditional financial services providers. And these service providers don't even, the majority of them don't even realize this is happening. It's moving so fast on the blockchain with DeFi applications that the banks and institutions and investors, people working there, are clueless about what's going on. And the returns are fantastic. The innovation is game breaking, and you don't see that around in the traditional markets. Decentralization's financial ultimate goal, like I say, DeFi often harnesses open source code, giving anyone the opportunity to build on pre-existing applications in a permissionless, composable manner. Some decent words in there. Finance is easy to understand, but what is decentralization? In short, decentralization means that no chief body controls something, and that's really a super strength. To an extent, banks and other financial institutions have power over your funds, and they do, and they manipulate and all sorts of other things. So it's really great to be freed from all that, and that's why they're going to eventually be threatened by it, as governments already are by blockchain cryptos like Bitcoin. These entities can freeze your assets, and you are at the mercy of their hours of operation and cash reserves. You really are, and they have credit policies, they have rankings, all sorts of stuff that really are draconian and authoritarian. So it's really great to see the separation there. The decentralization aspect of DeFi is not only a dispersal of power, but also a dispersal of risk. For example, if a company holds all the customer data in one spot, a hacker needs to only to access a particular site for a vast amount of data. In contrast, of course, sorting that data across several locations or removing that single point of failure could improve security. So that's fantastic. DeFi versus traditional finance. So let's get into some of the heart of it. For this comparison, commercial banks will be used as an example. In the traditional world, you may use financial institutions to store your money, borrow capital, earn interest, send transactions, etc. Commercial banks carry a lengthy, proven history of performance. Commercial banks can provide insurance and have security measures in place to ward off and protect against theft. On the other hand, such establishments hold and control your assets to a good degree. You are limited by banking hours for particular actions, and transactions can be cumbersome, requiring settlement times on the back end. Additionally, commercial banks require specifically more details and identifying documents for participation. A lot of people get sick of that. You know, you got KYC, know your customer, AML, of course, anti-money monetary laundering laws and stuff like that. And people want to be decentralized. A lot of people want more not to be anonymous these days, all that sort of stuff. DeFi is a segment that comprises financial products and services that are accessible to anyone with an internet connection, operates without involving involvement of banks or other third parties. That's the other side of it. People from all around the world, not just within a country, all around the world can get access to these innovative products, and really, particularly in developing countries, lift them out of poverty if they get involved early enough. The decentralized financial market doesn't sleep, and therefore transactions take place 24/7 and near real time. And this is the other benefit, right? So it's non-stop, while no intermediary has the power to stop them. And that's a wonderful thing, free from those draconian people. If you've been to a bank trying to get a loan or this or that, then you're just, you know what I'm talking about. If you want to go get 0.5% interest then through a CD in a bank, then you know what I'm talking about. It's not great stuff. You can store your crypto on computers and hardware wallets and elsewhere and gain access at any time. Bitcoin and most other cryptocurrencies hold these characteristics due to underlying technology that back these assets. Thanks to DeFi dependence on blockchain technology, transactions are completed faster, cheaper, and in some cases more securely than they would with human intervention. Decentralized finance seeks to use crypto technologies to solve a plethora of issues that exist in the traditional financial markets. So you can see here the traditional financial versus DeFi, a nice little comparison, traditional and DeFi. So traditional users must share their personal data, which is vulnerable to security breaches. The unbanked or underbanked can't access traditional financial services, and this is even a percentage of the US country. You know, I think it's something like 8% or something are relatively unbanked or unbankable. Payments can be intercepted and markets can be shut down. The clearing and settlement of transactions can take days. So for an international transfer, for example, using the SWIFT system, it takes about 3 days between banks. So that's really a problem. Whereas in crypto, it's basically instant in most cases, or very fast. The hours of operations are limited, of course, whereas crypto on the blockchain is open 24/7. Now, DeFi, no need to disclose personal details, just connect a digital wallet. However, some cases people will be asking for KYC and things like that, particularly if they're operating in Europe. Users custody their own funds, easier to avoid loss of funds. So that's the thing. You are your own bank. You have your own wallet on a blockchain, like a MetaMask wallet, and so you do have more responsibility. But in return, you get all that freedom and less hassles from centralized authorities. Trustless, of course, no need to worry if a protocol will do what it says it will do, and speedy transactions are completed in near real time, and it's a beautiful thing. The DeFi markets operate around the clock 24/7, 365 days a year. So that's pretty cool. Overall, DeFi, of course, gives participants the opportunity to access borrowing and lending markets, take long and short positions on cryptocurrencies. So long means to think the price is going up. Short positions means it's generally going down, particularly in margin trading. Each returns through yield farming and more. So yield farming is hugely popular. You do have face permanent loss slash risk or capital gain, but it has super high yields. You can get yields in the hundreds of percents to thousands of percents to over 100,000% in a few cases for a little while. Those don't last for long. Decentralized finance has potential to be a game changer for the 2 billion unbanked people in the world, particularly those who don't have access to traditional financial services for one reason or another. So you've got countries like Latin America, continents like Latin America. You've got the African continent, the Indian, Asian continent countries. A lot of that stuff, a lot of them are getting into crypto, and it's lifting them out of poverty in some cases. So it's really good. DeFi solutions are built on various blockchains with the ecosystem composed of participants interacting in a peer-to-peer, that's a P2P fashion. So that means from one to one over the blockchain. It's trust, as you see, facilitated by distributed ledger technology and smart contracts, which keeps the system in check. Such results are not bound by geographic borders and do not require identifying documentation for participation, which is wonderful, right? Real freedom there. And you get that trustless confirmation that the transaction is going to go through. The framework of, because it's recorded on the blockchain, the framework of this financial system functions according to programmed rules. Instead of using an intermediary such as a bank to borrow capital, you would send an amount of a specified currency to a secure digital location, what they call a smart contract, special code that's written onto the blockchain as collateral for your loan, receiving a different asset in return. So that records that transaction and it's locked down on the blockchain. Your collateral assets would then sit locked up until you send them back to back the loan amount. So basically, you can deposit your crypto and then borrow on that, and try and make more money with that perhaps, and then you've still got your original crypto. You can pay it back just like a loan. So it's pretty neat. Though you may or may not interact in a straightforward peer-to-peer manner, when using DeFi tech solutions, the spirit of the process is peer-to-peer, and that third parties are replaced with technology, not ruled by a central authority, which is a really wonderful thing. It really is a game changer. What makes up DeFi? DeFi boomed in 2020, bringing in an influx of projects into the cryptosphere and popularizing a new financial movement. Since Bitcoin essentially holds many DeFi characteristics, no firm start date exists for the inception of the DeFi sector other than Bitcoin's launch in 2009. But I would really say that most of the matured DeFi has really did start in 2020. In 2021 is next generation. You get next generation DeFi projects. Like I say, WiseB is a perfect example of that. Um, and so, yeah, that's pretty amazing. We can talk more about in another video. Following 27, however, a number of ecosystems such as Compound Finance and MakerDAO gain prevalence, popularizing additional financial capabilities for crypto DeFi. In 2020, the DeFi niche really took off as additional platform services in line with folks harnessing DeFi solutions for strategies such as yield farming. So it's pretty huge. So let's have a look at some stuff. Decentralized exchanges, DEXs, became popular last year and are certainly flourishing this year in the bull run. And DEXs allowed users to trade digital assets in a non-custodial way without the need for an intermediary or third-party service provider, what they call a centralized exchange, something like that. Although they comprise only one element of the DeFi sector, DEXs have been a part of the overall crypto industry for years. They offer participants the ability to buy and sell digital currency without creating an account on exchange. And often those exchanges, like quite a few of them will need KYC, know your thing, and that means providing passports, IDs, things. So it kind of breaks down that old, blockchain benefit in some degrees. DEXs let you hold assets away from the centralized platform while still allowing for trading at will from your wallet via transactions that involve blockchains. Automated market makers, a type of DEX, became prevalent in 2020 and used smart contracts and liquidity pools to facilitate the purchase and sale of crypto assets. DEXs are typically built on top of distinctive blockchains, making their compatibility specific to the technology which they are developed. DEXs built on Ethereum blockchain, for example, which the biggest one's called Uniswap, for example, facilitate the trading of assets built on Ethereum, such as ERC20 tokens. And yeah, Uniswap is the biggest one in the world and the most well known. You just basically connect your MetaMask wallet or a different wallet that you have, and you can trade different currencies on Uniswap on the Ethereum blockchain. Using DEXs require having compatible wallets in general. Self-custodial wallets, crypto wallets let you control your assets, and some of them are compatible with DEXs. However, this type of asset storage puts more responsibility on you for the security of your funds. You really become your own bank. You are the banker, as so to speak. Additionally, certain DEXs may have fewer features and higher associated financial fees than centralized exchanges. DEXs have come a long way in terms of liquidity and accumulating a regular use base, which continues to grow as DEXs become more scalable. That is faster and more efficient. Their trading volumes are expected to increase even more. And so this has obviously got a lot more complicated now, and we'll probably touch on those just at the end of this article. Aggregators and wallets is another one. Aggregators are the interfaces by which users interact with the DeFi market, and most decentralized asset management platforms that automatically move users crypto assets between various yield farming platforms to generate the highest returns. There's some really good ones like that. Wallets are locations for holding and transaction digital assets. Wallets can store multiple different assets or just a single asset, like Ethereum, for example, and can come in an array of forms, including software, hardware, and exchange wallets. Self-hosted wallets are wallets for which you wallets which can store multiple assets. So yeah, wallets for which you can manage your own private keys. So your private keys are your basically the key to your wallet, and you don't want to lose those or give them out because otherwise people can take your funds. Can be a key component of DeFi, helping facilitate the various DeFi platform uses depending on your wallet. Exchange-based wallets, in contrast, govern your private keys for you, and that means they basically own your keys and your coins until they give them back to you, giving you less control but also less security responsibility. But really, if you don't have your keys, you don't really own your coins. So just take that into account. Decentralized marketplaces. Decentralized marketplaces, of course, represent a core use case for blockchain technology. They put the peer-to-peer networks and that they allow users to transact with one another in a trustless way, and that is without the need for an intermediary. And that's just wonderful, right? That's just the key, the core part there, really. The smart contract platform Ethereum is the top blockchain facilitating decentralized marketplaces, but many others exist that now allow users to trade or exchange specific assets, such as non-fungible tokens. And one of the better ones of that is Phantasma Chain. They're probably the leading non-NFT technology in the world. So that's sort of an example there. Oracles and prediction markets. So oracles deliver real-world off-chain data to the blockchain. So it's really around that data part there, or database, to the blockchain via a third-party provider. Oracles have paved the way for the prediction markets and DeFi crypto platforms, where users can place bets on the outcome of an event, ranging from elections to price movements, for which the payouts are made via a smart contract governed automated process. So that's another aspect of DeFi. Layer one, of course, layer one represents the blockchain that the developers choose to build on. There is also layer two, but you don't tend to own the coins on those layers, so just take that into account. Layer two might be something like Matic, things like that, and quick swap, stuff like that. It is where the DeFi applications and protocols are deployed. As discussed, Ethereum is the main layer one solution in decentralized finance. And some say that they can probably have about 85% of the applications on Ethereum. That may be changing pretty fast, though, too. There's lots more blockchains coming up. But there are rivals, including Polkadot, Binance Smart Chain, and obviously Binance Smart Chain is related to the biggest centralized exchange, Binance, and that's how they've played that up. Tezos, Solana, and Cosmos, and there's many more now. These solutions will inevitably interact with one another as the DeFi space matures. And how they do that is what they call through bridges. So there'll be bridges between layer one and layer two blockchains, and between layer one and layer one blockchains, etc. So, and layer two and layer two. So you see how it works. There's another technology in DeFi spaces, bridges, not really covered in this article, I believe. Having DeFi sector platforms run on different blockchains has a number of potential benefits. Blockchains may be forced to improve speed and lower fees based on the performance of competing blockchains, creating a competitive environment that potentially resolves in improved functionality. The existence of different layer one blockchains also leaves more room for development and traffic instead of everybody trying to pile on into single layer one. So it really stops congestion happening really, and helps the DeFi sector grow in volume. So that's a big deal. Use cases to help answer the question, what is DeFi? It helps to explore its use cases, and this is really getting to the heart of the DeFi now. Whether you want to lend or borrow, trade on DEXs, stake your digital assets. So stake means kind of investing, like a sort of deposit, but it's a little different. Typically, you stake your coins and you get shares in return, and your coins get destroyed until the stake matures, and at the end of the investment period, then you get the coins back plus the interest. Or something even a game. There are new ways to satisfy those needs. Below is a list of some of the key use cases for decentralized finance. So this is probably getting to the nitty gritty to what you want, or the meat on the bones, as it were. Lending platforms, lending and borrowing have become some of the most popular activities in DeFi. I would say the most valuable, actually. Lending protocols allow users to borrow funds or using their own cryptocurrency as collateral. Decentralized finance has seen massive amounts of capital flow through its ecosystem, with lending solutions commanding billions of dollars in total value, or TVL, and the amount of capital held locked in any solution at a given time. And this is a big deal. And like I say, Wise is going to be doing with no interest, no profit taking. So it's really all 100% of profits go back to the users. That's coming up in September, October. So watch out for that. Payments and stablecoins. In order for DeFi to qualify as a financial system comprising transactions and contracts, there must be a stable unit of account or assets. Participants must be able to expect that the bottom will not fall out in the value of the asset they're using. This is where stable coins come in. So it's basically like having US dollars, and they have them on the blockchain instead. Typically backed one for one, but not in every case. So interesting there. Stablecoins bring stability to the activities that are common in the DeFi market, such as lending and borrowing. Considering the stable coins are generally pegged to fiat currency, such as US dollar or euro, they don't exhibit nearly as much volatility as cryptocurrencies and therefore are desirable for commerce and trading, and also risk management, right? So if you think a crypto is going to go down, you could sell all your crypto into US dollars and protect that US dollar value. And then when the crypto's gone down really far to where you think, you can then buy it a lot more than back because you've got the same US dollar value to buy them. So some really good stuff there for risk management. Margin and leverage. So margin and leverage components take the decentralized finance market to the next level, allowing users to borrow cryptocurrencies on margin using those cryptocurrencies as collateral. So you can get many times more. So you could get 3x, that'd be 3 times more. You could, instead of buying using, if you only had $100, you could get 3x on that, borrow another $200, and then put that on the market and get 3 times the returns. That's a lot of risk, of course. You're trading on the market, and so you've got to take that into account. All right, so in addition, smart contract program to include leverage to potentially ramp up the user's returns. Just as I just explained, the use of these DeFi components also increases the risk exposure for the user, especially considering that the system is based on algorithms. There's no human component if there's a problem. Often, if you go past your lending amount, you can get liquidated and lose the money. So just take that into account. DeFi native activities. Liquidity pools are necessary too for many decentralized exchanges to facilitate trading. So each token pair you have will have a liquidity pool. It's basically what it's saying, and people will have to provide that. And the only one that doesn't have a one that you can rug pull or pull out all the money, all the investors pull the money out of the pool, is Wise, actually. So you can see that that's why it's such a good one to use on this. They provide trading liquidity for buyers and sellers who pay a fee for their transactions. To become a part of a pool, liquidity providers can send specific funds to a smart contract and receive pool tokens. So that's a very important term. So when you provide liquidity, that you normally give some two sides of the coin. So if it's US dollars and Ethereum, you'd give a half and half of both of those in most cases, and you get what they call liquidity provider liquidity pool tokens in return, called LP tokens. And so that's how you go, and they actually go to your wallet. And in some cases, you can actually stake those at other platforms and get rewards for doing that, in addition to the fees that you make on the liquidity pool. So it's pretty neat. Earning passive profit, you do face impermanent losses though, which is where the capital amount can move up and down depending on the relative prices that of the assets. Earn passive profit based on the fees traded pay when they interact with the pool. So everyone that buys and sells will end up paying a small fee, and that will go to the liquidity provider people. Typically, it's like 0.3%, something like that. Pool tokens are the key to getting your deposited funds back. Yeah, so you take those LP tokens that you get for liquidity, and if you want to get your money back from the pool, you get those back. Of course, the ratio will be different depending on how the prices have gone in the pool there of what tokens you get back. Sometimes known as liquidity mining, yield farming is another activity in the DeFi space involving searching for profit via various DeFi projects through participation in liquidity pools. While there are intricacies to yield farming, there is one reason that market participants are flocking to this phenomena. It allows you to use your crypto holdings to earn even more crypto. Like I say, this can run into thousands of tens of thousands of percent returns, but they can often only last a certain amount of time, depending on the rewards that those platforms are providing. Examples are QuickSwap, Adamant, ViperSwap. Those sort of platforms like that are examples of where you get high yield farming, but once again still face impermanent loss risk of the underlying capital depending on the movement of prices and the whole market as well. By yield farming, users lend out their crypto to other users and earn interest that is paid in crypto, usually governance tokens that give liquidity providers a say in the operation of the protocol. It is a way for investors to put their crypto to work to enhance returns and is key innovation in the DeFi market. Yield farming, of course, has been dubbed the Wild West of DeFi, and it's a little bit like Wild West, but you can earn some pretty good returns as well if you pick the right projects, etc. With market participants hunting down the best strategies that they can then keep close to the vest, so they're not to tip their hand to other traders and lose the magic. DeFi risks, of course, we always got to talk about DeFi risks. For all of this promise, the decentralized finance space remains a nascent market that is still experiencing some growing pains. Yeah, so that said, you can find the cream of the crop projects are innovating and giving back 100% of the profits and also minimizing the risks, particularly when they lock in liquidity into pools. Those are the projects that you could look for. Wise is definitely one of those, so you can take that into account. They're really changing the game in the space there globally. It's really the frontier of DeFi. DeFi has yet to reach a wide scale adoption, so there's a lot more people to uptake it. Like I say, this is really taking traditional finance by storm. They have no idea that this is happening, really are clueless. And in order for it to do so, blockchains must become more scalable. Blockchain infrastructure remains in its early form, much of which is clunky to use for developers and market participants alike. But that's changing very fast in 2021, and I would say by 2022 that a lot of those issues would be solved. When using some platforms, transactions move at a snail's pace, and this will continue to be the case until scalability improves, which is the idea behind the development of Ethereum 2.0, also known as ETH2. But of course, there's other chains that already beat ETH2 to the market out there, ETL, Pulse chains coming up, others are out there as well. Flat on ramps to DeFi platforms can also be painfully slow, which threatens to hold back user adoption. Uh, and I think another one's Casper's coming up, so that's coming up too. DeFi has grown significantly given its youth and innovation. The legal details around DeFi have not likely not fully materialized. That's true too. Governments across the globe may aim to fit DeFi into their current regulatory guidelines. It's actually moving so fast that it's hard for them to keep up with it, to be honest. Or they may construct new laws pertaining to the sector. Conversely, DeFi and its users may already be subject to specific regulations. In terms of adoption, of course, it is uncertain how exactly things will pan out in the future. One potential outcome might include traditional finance adopting aspects of DeFi while retaining elements of centralization rather than DeFi completely replacing the mainstream financial options. Any entirely decentralized solutions, however, may continue to operate outside of mainstream finance. Now, that being said, a lot of these teams that are like Wise, for example, have mathematicians. They're innovating at the very frontier. These traditional big banks and stuff have no idea. They are running certain things on the blockchain and stuff, but in terms of actual specific DeFi innovations, they are miles behind a lot of these teams. So there we are, folks. That's it. I hope you enjoyed that one. Feel free to subscribe, like, and share, hit the bell for notifications. And of course, we'll be doing more videos covering some of these basic ideas around cryptocurrencies so that you can get up to speed really quick. So I hope you enjoyed that one. Once again, subscribe, like, and share, and hit the bell for notifications. And this is your host, Superman from Axiom Token. Cheers. See you next time.